The Dutch tulip bulb market bubble, also known as Tulip Mania, is a famous example of market going crazy and then crashing. This happened in Holland in the early to mid 1600s when people started guessing about the value of a tulip bulbs. At the highest point, the rarest tulip bulbs were sold for 6 times what an average person makes in a year. Now, when we talk about Tulip Mania, it's a story that warns us about being too greedy and taking big risks when we invest our money. It shows us what can happen when people get carried away and make decisions based on speculation. The Dutch tulip bulb market bubble has its root in the 16th century when tulips first came to Europe through spice trading routes. These exotic flowers, unlike any other Europe, quickly became a luxury item, especially popular among the wealthy. It was considered a sign of wealth to have a collection of tulips in one's garden. As the affluent embraced tulips, the rising merchant middle class in Dutch society, which was more developed than elsewhere in Europe at the time, also wanted to display the prosperity by owning tulips. Initially, people bought tulips simply because they were expensive and a status symbol. However, tulips were delicate and needed careful care to survive. In the early 1600s, experts in cultivating tulip developed techniques to grow and produce these flowers in Holland. This led to a thriving business that continues to this day. As per information from Smithsonian Magazine, the Dutch discovered that tulip could be grown either from seeds or bulb on the mother bulb. If the bulb grew from a seed, it would take 7 to 12 years before it could produce flowers. However, a bulb itself could bloom as early as next year. The broken bulbs were a special kind of tulip with a striped, multicolored pattern instead of a single solid color. This unique variety resulted from a mosaic virus strain. These distinctive broken bulb tulips sparked a growing demand for rare varieties, contributing to their high market price. This demand played a crucial role in the phenomenon known as Tulip Mania. In 1634, Tulip Mania took hold of Holland. The desire among the Dutch to own tulip bulbs became so intense that it led to neglect of the country's usual activities, with people from all walks of life getting involved in the tulip trade, as noted by the Library of the Economics and Liberty. During this period, a single tulip bulb could be valued as an astonishing 4,000 to 5,500 florins. To put this into perspective, considering the value of 1630s florin in today's dollar is challenging, but Scottish journalist Charles Mackay provides some comparison in his 1841 books. For instance, 4 tuns of beer cost 32 florins, which would equate to around $7,800 today. Using this estimate, the most priced tulips would be valued at over $1 million in today's money, although many bulbs traded in the range of $50,000 to $150,000. By 1636, the demand for tulip became so substantial that dedicated markets for their sale were established on the stock exchange of Amsterdam and in other towns like Rotterdam and Haarlem. Professional traders or stock jobbers joined the frenzy, and it seems like everyone was making money by simply possessing these rare bulbs. At that time, there was a widespread belief that the tulip market would keep growing forever. However, a significant part of the rapid decline in the tulip market occurred because many people had bought bulbs on credit, expecting to repay their loan with the profits from selling the bulbs. When price started to fall, these holders were forced to sell at any price, leading to bankruptcies. The once thriving tulip market quickly collapsed. In late 1637, the Tulip Mania bubble finally burst. Buyers who had committed to paying high prices for tulip bulbs announced that they couldn't fulfill their agreement, causing the market to collapse. While the economic impact on the nations wasn't devastating, it did shake social expectations. This event damaged relationships based on trust and people's ability and willingness to fulfill their financial commitments. According to Smithsonian Magazine, Dutch Calvinists depicted and exaggerated pictures of economic ruin, fearing that the consumerism frenzy fueled by tulip would lead to social decay. They argue that such immense wealth was morally wrong, and this belief continues to influence perspective to these days. The fascination with tulips has captivated the public imaginations for generations and has even inspired works like novels Tulip Fever by Deborah Mogash. According to popular legend, the tulip craze in the 1630s affected all levels of Dutch society. As Charles Mackay wrote, the wealthiest merchant to the poorest chimney sweeps jumped into the tulip fray, buying bulbs at high prices and selling them for even more. Tulipmania serves as a blueprint for typical cycle of a financial bubble. Step 1. Investors lose track of rational expectations. Step 2. Psychological biases contribute to a significant increase in the price of an asset or sector. Step 3. A positive feedback cycle continues to drive prices higher. Step 4. Investors realize they are holding an irrationally priced asset. Step 5. Prices collapse due to massive sell-off leading to widespread bankruptcy. Similar cycle has been observed in prices of Beanie Babies, baseball cards, non-fungible tokens, NFTs, and shipping stocks. During the Tulip Mania, Dutch speculators spent enormous sums on bulbs that only produced flowers for a brief period, and many companies were formed solely for trading tulips. The peak of the trade occurred in the late 1630s. In the 1600s, the Dutch currency was the guilder, predating the euro. At the height of the tulip bubble, tulips were selling for around 10,000 guilder. In the 1630s, these prices were equivalent to a value of mansion on the Amsterdam Grand Canal.